Good evening, everyone. Welcome to our Riverside Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Really excited to bring this information to you. We get a chance to present this content every couple of weeks here from our offices to first-time homebuyers just like yourself. Now, we're going to get a chance to go through tonight's content. We really try to make it an interactive session. So I think many of you have probably seen in the chat box, Ken's reached out to you. And so we can get a chance to share some of your questions as we roll through tonight's content back with the rest of the audience. So we really encourage you to bring those questions to us, and we'll kind of share those back with our audience here. So let's talk a little bit about what our plan is for this evening. So actually, before we talk about that, let me tell you a little bit about me. Again, my name is Jason Maida, and I've been in the lending industry for just over 20 years. We focus in on first-time homebuyers. So as one of the top originators here in the California market, we focus on supporting first-time homebuyers, and we do that by kind of valuing education. So we really try to make it an educated process as we move through from pre-approval all the way up to getting your keys. We really want to make it a high-touch experience for you. We are specialized in first-time homebuyer assistance programs, so you're going to learn a little bit about that this evening as well. So tonight we'll kind of talk about the CalHFA assistance program, and it's designed to help low to moderate income households. We'll also spend some time looking at a variety of different products, including conventional loans, FHA loans, VA, USDA, and like I said, we'll talk a little bit about CalHFA. So now let's talk about our discussion points for this evening. So we're going to look at the housing market, lots to talk about there, including what are interest rates doing. So that's a big topic of conversation, especially given the Federal Reserve's announcement today with the rate increase that we're going to see. We're going to talk about does buying make sense? So we're going to do a quick little budget analysis for you so you can see it comparing in renting versus what it looks like from a buying perspective. We'll look at credit. We'll give you some tips and some resources on really understanding where I'm at from a credit perspective and where I could go with credit. We'll look at student loans and maybe how those can impact our qualifying. We'll talk about loan programs. Like I said, FHA, conventional loans. We're going to look at how different loans can help support you with your home buying. Talk about some of the documentation that you'll need as you start the consultative process towards buying. And then we'll look at down payment assistance programs and how that can support you with both down payment help as well as closing cost help. And then we'll wrap up tonight's conversation looking at the process. We call it our 6 steps of home buying. So we're going to look at what does it take to go from pre-approval all the way to step 6 of getting the keys to my house. And that comes out of, or the pre-approval is the output of a consultation. I'll kind of walk you through the framework of a consultation too this evening. So that's what we're going to share with you tonight. Hopefully you really enjoy the content. And again, I would really encourage questions as we go through tonight's conversation, and then we can share those back with the rest of the group. So let's first talk about buying. And when we're thinking about home buying, and by the way, for all of you guys that are joining us this evening, you're taking the time out of your busy evening to be able to learn about home buying. So kudos to all of you, because this is probably going to be one of the largest purchases you make in your lifetime. So taking the time out to do all of this work to really understand home buying is super important. It's really going to prepare you to be in the best possible position when it comes to home buying. When you think about buying, because it is going to be one of the largest investments you make in your lifetime, there's some great benefits that come along with it. The ability to be able to create stability in your housing payment. So we don't have to worry about maybe our rent increasing year over year as we sign new leases. So you're a little bit more in control there. You do create equity in your home. So as your home appreciates, that creates equity. So the amount of what I owe on my mortgage versus how much the house is worth, that difference is called equity. And as you grow in equity, you're creating that larger asset that you can possibly pass along that asset to the heirs of your estate. And finally, with purchasing a home, there still is some tax benefits that come along with purchasing. So even though there was some tax changes back in 2018, you still have the ability to potentially deduct interest on your mortgage. So a lot of great things that come with home buying. So one of the first places we want to start with tonight's conversation is looking at a budgeting tool, and that's called our rent versus buying calculator. So the tools that we share with you this evening, we're going to actually send those out in our presentation deck page tomorrow. So be on the lookout for that, but really encourage you to take great notes tonight. But we'll get you all the material that I review with you this evening tomorrow. So let's talk about renting versus buying. And this tool from Freddie Mac can really help you understand, what it's going to look like if I'm going to compare my rent situation and then how I stack that up side by side with home buying. So what we're going to do is we're going to kind of go through this exercise together, and we'll kind of input these fields, and then we'll come out with kind of the what it can look like in comparison that rent versus buying. So let's start with a monthly rent amount. So I'm going to put it just a random number of, we'll say $2,000 a month in rent. We're also going to assume monthly renter's insurance. So those of you that are renting, you probably have insurance on, the personal property that you have within your rental property. We'll assume 3% rent increase. So assume every year that I sign a new lease, my rent's going to go up 3%. Then let's look at the home purchase, and let's go ahead and pull that back down a little bit. Let's go ahead and say 450,000. That's not a bad starting point. I know many of you are joining us this evening from various parts around California. Maybe you're joining from outside of California. So if you're looking in Riverside, it's going to look a little bit different than purchasing in San Diego or in the Bay Area. But let's use 450 as kind of our baseline for our conversation tonight. And then down payment, we're going to assume 3%. Property taxes, we can lower those down a little bit. We'll say closer to about $5,250. Generally, as a lender, we're going to use 1% to 1.25% of the purchase price to figure out your tax rate. Homeowners insurance, we're going to assume $1,000 a year for homeowners insurance. And then yearly maintenance, we want to carve that out in our budget as well. So we're going to say about $2,000 a year here. Now, if we purchase an older property, maybe the maintenance is a little bit higher, but we want to factor that into our budget. And then loan information, we're going to assume a 30-year mortgage. We're going to put a 4% rate. By the way, we're going to talk a little bit about rates here in just a few minutes because that's an ever-changing topic. Origination charges. Origination charges are how much you're going to pay for your lending services. Usually there's a processing fees and underwriting fees. With American Pacific Mortgage utilizing our services, we usually have a $910 processing fee. However, with our UC Riverside discount, that gets dropped down to $160. And then we have a $995 underwriting fee. So lender charges are part of your overall closing costs. And when we look at closing costs, we probably want to assume anywhere between 2 to 3% of our purchase price will be our total closing costs. Now that will vary depending on what you negotiate with a seller, but roughly that's what the number would look like. Discount points, we're going to put 0 for right now, but discount points allow you to what we call buy down your interest rate. So if your interest rate is 4% today with no discount points, a discount point, which in most cases is 1% of your loan amount. So let's say we're financing $400,000, that would be $4,000. That 1% of discount point allows us, generally speaking, to reduce our rate by 0.25%. So if I'm at 4% with no points, potentially I may be at 3.75 with 1 point. Okay. And then other settlement charges will be things like title, escrow fees, maybe transfer taxes, some of the recording fees for the county that you're going to purchase in. We're going to assume for this exercise here that we're going to say $6,000, give or take, for other settlement charges. The last section on the other assumptions is going to be appreciation rate. So we're going to assume our home's going to hopefully appreciate 3% year over year. Of course, now in this market, we've seen appreciation rates that are much higher than that, but we want to kind of assume conservatively here for this exercise. And then we're going to say we're going to be in the house for 7 years. This 8% of selling costs, what that means is once I sell my home 7 years from now, that the cost of selling that home is roughly 8% of that price. Now, that 8% is inclusive of realtor fees, some of the closing costs that you'll pay as a seller. When you are represented as a buyer purchasing your home today, the buyer's commissions are paid for by the seller. Now, when you turn around and sell your home, let's say 7 years from now, you're going to be responsible for, as a seller, the buyer's agent commissions, as well as the listing agent that represents you as a seller. And then finally, we'll have the tax rate, state and federal tax rate of 33.8, and then we'll put the savings rate of 1%. So what this analysis says to us is that, over the next 7 years, if I continue to make rent payments of roughly $2,000 a month, as opposed to maybe buying, which is going to be a higher payment, of course, right? Because now we're buying a $450,000 house. That payment difference is about $1,100 a month, or $3,100 total monthly for the mortgage, including taxes, insurance, potential mortgage insurance. When I compare those side by side, my total cost opportunity of buying versus renting is about $65,000 over 7 years. Now, how do we come up with that? That's attributed to tax savings, that's attributed to equity growth in my home as I look over the next 7 years. So that's about a $65,000 opportunity. Now, if you have a lower rent payment or you're trying to buy a much higher purchase price home, then those numbers might look a little bit differently. But all in all, over 7 years, if we're going to continue to rent at $2,000 a month versus purchasing it around $450, that's the opportunity for us. Okay, so I would encourage you, once you guys get the presentation material, please feel free to put your own inputs in there, and hopefully that'll give you a good guideline for what it could look like in budgeting for your home purchase. Okay, let's go ahead and keep things moving. I'm going to continue on here. We're going to talk now a little bit about the housing market, and we're seeing a lot going on with the housing market, especially as we're entering the spring and summer buying months, which is always pretty exciting because hopefully it'll bring to us more inventory. And what we've seen over the last couple of years is just a lack of inventory, but super high buyer demand, which is creating really pricing wars. It's a very competitive climate out there. And if we can get more inventory on the market, then hopefully that'll start to kind of stabilize prices right now. But as you can see, and we're going to look at the Riverside, San Bernardino, Ontario markets. This gray line here represents the start of the pandemic. And as you can see, the price of homes just absolutely shoots upward really quickly. And this doesn't look any different for the Orange County markets, LA County, if you're up here in the Bay Area, Sacramento markets, because we've seen this across all the markets in California. So some are a steeper increase than others, but all in all, it's very similar to what we have depicted in this graph. So what's leading to that? Well, you've heard me talk about it a little bit already. Inventory levels, they're just at levels that don't support the buyer demands, and the buyer activity is being driven behind, I should say, lower interest rate environment, change in work environment. So, we can go buy a house out in Riverside. No longer do I have to commute into downtown LA. I can work from home. So that has changed the landscape for buyers. And I think just as we're looking at just answers to figure out, better affordable housing, a lot of buyers are turning to home purchasing. And so, the buyer behaviors have definitely shifted over the last 2.5, 3 years. And we're seeing that trend continue now. Like I said earlier, hopefully inventory will help support what buyer needs we have out there. Now, we are seeing early signs of a little bit of softening in the market. And what I mean by that is, you're seeing some homes that are at a purchase price of, let's say, $450,000, but because of the rapid or the buyer competition, it's pushing that purchase price up super high. But the data available to home appraisers is not supportive necessarily of that $450,000 purchase price. So now we're seeing appraisals coming in at maybe $440,000, $430,000. And where that can tend to be a bit of an issue is that as a lender, I only can lend on the appraised value or purchase price, whichever is less. So if a buyer's appraisal only comes in at $430,000, but they're buying the house for $450,000, that $20,000 difference that we have between appraisal value and purchase price needs to either be renegotiated with the seller or potentially made up the difference of the buyer's out-of-pocket expenses. So we're seeing more of that happening in the market, which leads me to believe that we are seeing a little bit of a softening. Now, the other thing that we're seeing right now is a pretty aggressive move upwards with interest rates. And so average interest rate now is pushing to about 4.25%. When we were teaching the same class last year, rates were closer to 3.25%. So we're about a full 1% higher than we saw in 2021. Now, it'll be interesting to see kind of maybe that does shift buyer behaviors a little bit. I don't think it's going to cool down the buyer competitiveness out in the market, I think, but it is going to change purchasing power for a lot of our buyers, because if you're now elevating interest rates by a full 1% and you were pre-approved at 3.25%, going up a full 1%, if nothing else has changed for you financially, may change your eligible amount as you're searching for homes. So now what's leading behind interest rate volatility right now is we're seeing high inflationary prices. And obviously those of you that try to get gas over the last week or so, seeing higher gas prices, higher cost of living for everything. And of course, what's going on overseas with the Ukrainian war. And that is obviously putting instability in the financial markets. And because of that, we're seeing interest rates continue to climb. The Federal Reserve today announced the 0.25% increase in the federal funds rate. So that was kind of already assumed in interest rates, but we're just seeing interest rates continue to climb, and hopefully we'll see a little bit of stability over the next few weeks, because interest rates, like I said, have kind of really risen pretty quickly. We've seen them rise about 0.5% to 0.75% just over the last month. So like I said, we are looking for a little bit of stability there. Now, this is kind of what we've seen over interest rates going back to the late 90s. Now, back then we did have interest rates that climbed well beyond 8%, but we've generally stayed in this kind of mid-4 level here. And then at the very lowest in the market, which was in 2020, October of 2020, we saw rates reach as low as 2.625%. So, and many existing homeowners that wanted to take advantage of the refinance climate were able to reduce their interest rates on their mortgages. Now, when we look at interest rates, they're going to come at different interest rate levels, and those will vary depending on what your credit eligibility looks like. If you're at a 740 credit score or better, generally, you're going to have the best available interest rates. It'll vary by loan product, how much you finance, how much you put for your down payment. The minimum down payment generally is 3%, but if we put 30% down, we could potentially have a lower interest rate. And then we talked a little bit about this earlier, which is just costs of buying the interest rate down or paying points. And for those of you that didn't get a chance to hear the commentary on that earlier, 1 point equals 1% of your loan amount. So 1% of, say, $450,000 would be $4,500. That point is used to buy down your interest rate. So if your rate is 4% today and you pay 1 point, that could potentially reduce your interest rate from 4% down to 3.75%. The other thing that can change your interest rate offering is the term of your loan. So a 30-year mortgage is generally what we're going to be looking at. That's when we talk about 4% or 4.25% rates. That's generally on a 30-year. As we reduce our term, we should usually see a lower interest rate offering. So if you did a 15-year term, maybe the rate option is maybe 3.875. So all those things are taken into consideration when looking at interest rates. Now, one of the biggest influencers of interest rates and kind of the product offering for clients looking to purchase is going to be credit. And every loan program has various credit minimums. So FHA loans, the minimum credit score is usually 600. It can go as low as 580 at times. Conventional loans, the minimum credit score is 620. VA is 620, so that's for our veterans that have served. And then the CalHFA product, which you're going to learn a little bit more about this evening, is a minimum score of 640 for an FHA loan, 680 for a conventional loan. Let's take a look at the FICO score calculation to see how the weighting is set up for FICO scores, because many of you that are joining tonight's call probably have some type of monitoring service. So maybe you use Credit Karma or Experian to see where you're at from a credit perspective. Those models used for credit monitoring are going to be with the credit card model. Whereas when you apply for a mortgage, we utilize the mortgage model. And so this is what that mortgage model looks like. So the FICO score is weighted as such. So 15% is going to be how long I've had credit. 20% is going to be how much credit I have in use or new credit I'm trying to access, also known as inquiries. Hard inquiries are where you're going to see the impact here. Now, the difference between a hard inquiry and a soft inquiry is that a hard inquiry could potentially put a mark on your credit report and lower your credit score. A soft inquiry gives a lender visibility just to look at your credit, but it does not put an impact in your credit score. Now, when you apply for an auto loan or even a mortgage, you have a 30-day window of time to apply with as many lenders as you want, and that's the equivalent of one credit inquiry hit to your score. So if I start my first inquiry today is what, March 16th, I have a 30-day window that begins today, and I can apply with as many lenders as I want in that 30-day window of time. Okay, so the other component of this is how much new account or how many new accounts I'm opening up as well. So that's something we want to be mindful of, especially over the last 12 months. We want to make sure we're not opening a lot of accounts. We'll have the inquiries, but we also want to make sure we don't have actually new trade lines. 30% is going to be how much I owe. That's also known as utilization of credit. And that's generally going to impact you on revolving credit. So with utilization, we're looking at how much I have in credit limits versus what I have in credit balances. So for example, if I have $10,000 in credit limits and my balances are $5,000, then I have 50% utilization. Ideally, we want to be below 10% utilization. If I'm running closer to maybe 80% utilization, I really want to try to get that utilization below 50% as kind of my starting point. And then as I've kind of mastered that, then I want to try to get below 10% utilization. Now, here's a quick tip for you if you're trying to kind of lower that credit card balances, but get the biggest lift on your credit score. So if you look at each one of your credit cards, there's a billing cycle date as well as a due date. Okay. And at the end of your billing cycle date is when your credit card issuer sends your balance, payment, interest rate information. That all goes out to the credit bureaus. And then you have a due date. And your due date's when you have to pay your payment or incur a late charge. Now, if you can manage your credit cards to pay down your balance or pay off your balance before the end of your billing cycle date, that's the data that's going to be shared with the bureaus. So for example, if I just charged $4,000 on my credit card this billing cycle, and my billing cycle ends on the 20th, if long as I can pay off that balance or pay it down before the 20th of my billing cycle date, then that's going to be the balance that gets reported out to the credit bureaus. So let's say I pay it off by the 19th of the month and I get it down to a zero balance. That's the balance that's going to show on my credit report. And why that's important is because then it's going to help lower my utilization. By lowering utilization, I improve my credit score. Okay, question, yes?
For credit card without a limit, how does that affect your utilization?
So the question is credit cards without limits. So generally, a credit card without limits, probably an American Express. I think, I'm gonna just make that assumption. So American Express usually has to be paid off every month because they have 30-day payment cycles. Sometimes you can split it off over multiple payments, but that shouldn't impact you if that's what we're referring to as American Express. Okay, so the last component or weighting to the score calculation is going to be payment history. And it's basically just how I've paid on time for my payments. So if you've had some past challenges, maybe you've been late on an account, it's rated as 30-day lates, 60-day lates, and then 90 plus. Okay, so we obviously want to avoid that at all costs. Now, lates that you've had in the last 12 to 24 months are going to be the most impactful to your credit score. If you've decided to do a balance transfer and then maybe you close out the old credit account that you've had, account closure can be damaging to your credit report. So you want to be careful with that because when you close out an account, let's say I've had an account for the last 10 years, let's say it's a Visa with Citibank. I close out that credit card because I got a better offer with Capital One. When I close out that account with Citibank, it pulls away all the great history that I've had for the last 10 years with Citibank from the credit model. And by doing that, I could possibly lower my score because when you think about it, if I get rid of that trade line, now my length of credit has been hurt. And then potentially my utilization, because now maybe I have less credit limits to work with. So just something you want to keep in mind. Now, when you're applying for a mortgage and you're looking at your credit scores, as a lender, we're going to look at all three bureaus, TransUnion, Experian, and Equifax. And we're going to take the middle score between those three agencies. So if I'm a 740 on Equifax, 720 on TransUnion, and then let's say a 700 on Experian, we're going to use the 720 middle score for qualifying. Now, if I'm applying with a partner and my partner has 700, 680, and 660 scores, then we're going to use the 680 score for qualifying. So we take the lowest middle between the two borrowers. Okay.
Another question.
Yeah.
So someone was asking about the difference between like the credit card scores and the mortgage scores. Do you have an online tool that you recommend for checking the mortgage?
Okay.
They were asking about.
Okay, so the question was, is there a tool that we recommend to check the credit card score versus the mortgage score? So I would check out, I don't know if Credit Karma has this option, but I know I subscribe to Experian. And Experian allows you to see all the different credit models. So you can look at mortgage, auto, credit card. I think you do have to enhance your membership. I believe it's $19 a month, if I'm not mistaken. But you get the credit monitoring, then you can see all the different bureaus. So if that's something you're interested in, I would check that out. Of course, if you do decide to consult with us for your mortgage, we're going to show you what your score is. That's kind of part of our consultative process as we develop, we call a credit game plan for you for home buying. when we look at any past challenges we've had, this matrix kind of shows you how long they'll stay with you on your credit report. So credit inquiries are usually 2 years or less. If you've had late payments, 7 years or less. Bankruptcies, 10 years. Any type of federal student debt generally be on your credit report indefinitely. Let's talk a little bit about student loans. I would say the majority of our clients we consult with have student loans. And so those of you that have federal student loans, those are on forbearance until I believe June of this year, and then you'll start your repayment program unless they get extended again. But that's part of the CARES Act with this at the start of the pandemic. When we qualify clients for financing, we do have to take into consideration the student loan payments, even if there's not a payment due right now. So usually there's kind of 2 product tracks we look at for first-time buyers. It's usually going to be a conventional loan or an FHA loan. Conventional loans, we can take the income-based repayment amount and use that for the qualifying payment. So let's say I have $75,000 in student loan debt, and I'm on maybe a $250 income-based repayment amount. That's the amount that we'll use for qualifying. However, if you haven't set up an income-based repayment amount, the default payment is 1% of that balance, which would be $750. So it would be obviously advantageous to have an income-based repayment amount, because that would change your monthly obligations by $500 per month. For an FHA loan, the default is 0.5% of that same student loan balance. So, that's roughly what, $375 per month. Same thing holds true if you're on an income-based repayment amount and it's $250 per month. That's the amount that we'll use for qualifying. So the way it works right now for clients that have income-based repayment amounts prior to the pandemic, so let's say I'm on that $250 IBR payment before the pandemic, as long as we can document that's currently what it is, and that's what you'll start paying in June, that's the amount we can use for qualifying. If you're back in school and maybe your loans are deferred, or you're in general deferment, we still have to count a monthly payment against you for your qualifying. Okay, we can always go back to that student loan section if you guys have any questions that pop up as we roll through the rest of tonight's content. Let's talk a little bit about loan programs. You learned just about the student loan component for conventional loans and FHA loans, but let's look at some of the product characteristics for some of the 5 core products that we offer for our home buyers. So many of you have heard of conventional loans, of course, FHA loans. VA loans for our veterans that have served as a 0 down payment requirement, and then USDA loans, which are becoming a little bit more popular as some of our buyers are looking at more remote areas to purchase. That has a 0 down payment requirement. USDA loans are geography specific, so they have to be designated USDA eligible properties. And then jumbo loans are anywhere between 10 to 15% down. Those are going to be for clients that are purchasing over $970,800. And that would be for LA County or Orange County. If you're in Riverside or San Bernardino, it's going to be clients that are purchasing over $647,200. Okay. Now, jumbo loans, in case that's something that you're interested in, the requirements look a little bit different. Usually, it's a minimum credit score of 660. With jumbo loans, we have to set aside a little bit more in assets. Not only will we need 10 to 15% down, plus our closing costs, which can be, like you heard earlier, anywhere between 2 to 3% of your purchase price, but you're also going to need something called reserves. And reserves are going to be usually 12 months equivalent of your monthly payment, principal, interest, taxes, insurance. And we have to have that in assets left behind after we've contributed our down payment and closing costs. It can be in the form of a 401k or a 403b. But let's say I have a $5,000 a month mortgage payment for my jumbo loan. 12 months of $5,000 per month is $60,000. So I would need $60,000 in assets left behind after I've contributed my down payment and my closing costs. Okay. Now, it's not common for our first-time home buyers to elect a jumbo program, but in some of our maybe lower conforming limit counties, I would say San Bernardino and Riverside County are some of the lower ones, for at least for Southern California compared to LA and Orange County, we may end up going to a jumbo loan level. Now, conventional loans and FHA loans are probably the most popular first-time buyer programs. Conventional loans require a minimum down payment of 3%. Up to $647,200. for San Bernardino and Riverside County. Now, when we go beyond 647,200, and if we're buying in LA or Orange County, that minimum down payment jumps from 3% to 5%. For FHA loans, the minimum down payment is 3.5%. You heard earlier the minimum credit score is 580. That's for loan amounts up to 647,200 for San Bernardino, Riverside. If we're looking in LA and Orange County, then it's a 3.5% down all the way up to 970,800. Now, when we put less than 20% down, we're going to have a thing called PMI, and that's also known as private mortgage insurance. And we like to kind of walk our students for our classes through this kind of side-by-side comparison of conventional loans versus FHA loans to kind of illustrate what PMI looks like. Now, with conventional loans, you have different options of paying or repaying your PMI. There's monthly PMI, there's split PMI, which is basically taking part of your premium that you pay back. You pay it monthly, part of it's done upfront. You can pay a single premium for your MI, and you can also do what we call as lender paid MI, which is taking a slightly higher interest rate in order to buy out the MI. And let me back up for a little bit to explain what PMI is. So PMI is insuring the lender against default of the buyer. So if something was to happen financially and you just weren't able to afford the payments and there was a default, the lender would be protected against that. So again, we have to pay PMI as a consumer when we put less than 20% down on our mortgage. Now, PMI on a conventional loan is calculated based upon your credit score, how much you put down, and how much you finance. Okay, that's how we get to the PMI premium. PMI on a conventional loan does have a cancellation option where when you potentially have 2 years in the home, or in the loan, I should say, the original loan, and 20 to 22% equity, you can apply to have the mortgage insurance canceled. If we looked at a PMI scenario for a conventional loan, let's say at a 450 loan amount, we're probably looking at about $183 a month. And that assumes like a 740 credit score and the minimum of 3% down. Often when I consult with clients, I hear that some of the calculators like on Redfin or Zillow will have a lot higher PMI payments. So just kind of keep that in mind when you're doing some home search on your own, you're using some calculators. Those are more often than not marketing tools to help get you connected with some financing options. But generally speaking, those PMI that they're showcased in those calculators are not accurate because to our point earlier, PMI is going to be based upon your credit score, your down payment, and your loan amount. And a lot of those calculators don't have that embedded into the tool. Now, FHA mortgage insurance looks a lot different than conventional mortgage insurance because the PMI that you pay on an FHA loan doesn't have those three factors of credit score, down payment, and amount finance. There's a factor of 0.85% of your loan amount. So if we took 0.85% of your amount finance divided by 12, that would be your monthly premium. But then with PMI on FHA, we also have upfront mortgage insurance, and that's 1.75% of your loan amount. That gets added on to your balance. So you finance a little bit more with FHA loans. With FHA, you cannot cancel mortgage insurance unless you refinance the loan and switch from an FHA loan maybe to a conventional loan. Okay, so that's what that would look like. Now, if you do put 10% down on an FHA loan, which is not likely for most of our clients, usually we'd switch to a conventional loan. But if you did put 10% down on an FHA loan, the mortgage insurance on an FHA loan cancels automatically to 11 years. Now with FHA, if we're going to compare the PMI versus the conventional loan, FHA PMI is almost close to double what it can be on a conventional loan. The PMI premium on a $450,000 loan amount, we'd have a $324 payment plus we'd have the upfront of $78.75. So clearly FHA mortgage insurance is a lot more expensive. So when we step back for a second, we may say, well, why would I ever go with FHA? Well, there's a variety of different reasons. It could be based upon credit qualifying. So maybe our credit score is a little bit lower, or maybe we've had some past challenges, like maybe a past bankruptcy, where maybe our bankruptcy was discharged 2 years ago and conventional wants 4 years for a bankruptcy discharge where FHA will allow 2 years. Or maybe we've had some late payments recently on credit cards. That may have us lean more towards an FHA loan versus a conventional loan. So each product that is provided to you has different guidelines. And that's when we do a consultation with you, comparing those different products, we'll have to discuss what makes the most sense for you based upon your current financial situation. Yeah.
First one, someone asked about mortgage brokers. So can you just describe the difference between banks, mortgage banks,
Okay.
and then
Okay. So a question just came in about the difference between, brokers and maybe other sources of lending. So if you look at the lending space, I would say there's kind of three categories. There's mortgage brokers, there's mortgage bankers, which is what we are, and then there's banks, big retail banks. So the retail banks would be like a Wells Fargo, Chase, B of A, things of that nature. Mortgage banks would be like what APM is, American Pacific Mortgage. And then mortgage brokers are kind of the go-between between the consumer and the source of funds, and then they collect a fee based upon them finding the right product solution for you. As a mortgage banker, we lend our own funds. We're approved directly with Fannie Mae and Freddie Mac and FHA. And so we make our own credit decisions all in-house, and then we fund using our sources. Very similar to what a big bank does. One of the biggest differences, though, a big bank is generally going to have other product lines like checking and savings accounts, investments, maybe insurance, whatever the case may be. So we're kind of more streamlined, focused on just the mortgage side of things. So hopefully that answers the question.
The second question was just clarification that you need both 2 years in the home and 20% equity.
Yeah, so just to clarify so the question came in about PMI, so it is 2 years and 20 to 22% equity for the cancellation on MI. Now you may hear different things, but that's kind of the rule I go off of. Some servicers will lean differently on that. The big thing is because if you had rapid appreciation, especially clients that have bought a year ago, just to go in and now cancel your mortgage insurance. If you think about it, the PMI companies do have, it's a for-profit type of service. So they're looking to see these premium payments made. And generally it's the lease for 2 years. Yeah.
PMI question.
Yeah.
PMI tax refundable.
So the question about PMI is not tax deductible. No. Deductible, right? Not refundable.
They said tax refundable.
Okay. So yeah, so PMI is not tax deductible. So where interest can potentially be tax deductible, PMI is not. All right, good questions. These are the conforming limits. You've heard me kind of talk about them as we've gone through tonight's discussion. So that's what they look like. I think you've heard me reference Riverside and San Bernardino County. So, and then if you guys are joining us from LA or Orange or San Diego, maybe even Ventura County, those limits are a bit higher. Let's look at documentation now. So as we're preparing to, put our home buying game plan together, this is some of the documentation that we'll generally need depending on what our source of income looks like. So if I'm a W-2 wage earner, usually we'll need the last 2 years of W-2s and the 30 days most recent pay stubs, and then some type of verification of employment. If I'm self-employed, it's going to be a little bit more labor intensive because we'll need the last 2 years of tax returns, usually a profit and loss statement and a balance sheet. And then we'll have to verify the business, either kind of checking out the website, maybe a business license or a CPA letter. Self-employed individuals, we are going to have to show a full 2 years of income to be able to utilize that source. Now, for different scenarios, if I am working dual employment, so let's say I'm in the healthcare industry and I work 30 hours at one hospital, 20 hours at another hospital, I do need to show that I've been working both jobs simultaneously for the last 2 years in order to count both sources of income. Now, if I'm new to the workforce, let's say I just graduated from UCR in the fall, and now I'm going to start my new career here in the next couple months. We do need to see 2 years of work history and or education. So let's say I graduated with my bachelor's in accounting, and now I'm going to get signed on with an accounting firm. And so because I went 4 years at UCR, now I'm starting into an accounting profession, that would satisfy the 2 year requirement. If you're transitioning jobs, let's say you're working for the state of California now, and now you're going to work for a private company, as long as you've had that 2 years or education behind you, you can transfer to that new job, and those new wages can be used right away, assuming it's base salary. So those are some things that kind of pop up a bit. Clients that are in transitions of new jobs, we can verify the income simply by using an offer letter. So here's an example. I have a client that just started their new job on Monday. They were pre-approved using their executed offer letter to go out and start looking at homes. As long as they get their first paycheck before their first payment is due, then we can use that income. So in this particular case, this client's first payment is not due until June, and they're going to get their first paycheck in a couple weeks. So that is verifiable income we can use for their home purchase. Okay. Is there any questions that come up with income that I'm missing? One question does come up is part-time income. So clients that are working less than 40 hours a week, for example. So if you're in a part-time job or a temporary status, we do need to show that you've been doing that for 2 years. Yeah.
Someone, let's see, they're considering leaving their current job to go to a different job, slightly less pay.
Okay.
So what is that? How does that affect qualifying?
So the question came in is they're considering clients or the students considering leaving a job and taking a job with less pay. So as long as it's full-time status, even though it's a reduction in pay, we are going to obviously use the current income. So if it's lesser income, that's what we use to qualify you for, even though past earnings are higher. That kind of leads me to another thought here to share with you guys. So especially with what's obviously our whole world has gone through with the pandemic in the last 2 years, obviously earnings have changed quite a bit, especially in 2020. So one question I get often is, my hours were half of what they were in 2020, and now I'm back to a full-time schedule. Is my 2020 earnings going to be considered in today's calculation? And as long as you're on a full-time status and we're not counting on overtime or any type of incentive pay, then yes, we'll use the present day income. If you're self-employed, unfortunately, we are going to have to average the 2020 tax year as well as the 2021 if you've already filed. But for W-2 employees, generally speaking, we can use the current income. Okay, let's stick with the topic around income. And so as we look at options for you for home buying, we're going to compare your income versus your obligations because we want to make sure we design a plan that's going to create affordability for you in home ownership. So one of the calculations we can use, it doesn't necessarily dictate affordability, but it's more on the qualifying side, is a calculation called debt to income ratio. And what debt to income ratio does is looks at your pre-tax income, or if you're self-employed, your net income, versus your monthly obligations, including the expected house payment. So if I have say a principal and interest payment along with my property taxes, insurance, and remember that PMI from earlier, and maybe I'm buying a condo with HOA expense or homeowners association expenses, if that monthly amount is $2,500 a month, plus I owe maybe $500 on a car loan, if I have $3,000 in monthly expenses and I'm making $8,500 a month, then we have a thing called a debt to income ratio. And that debt to income ratio says that basically 35.29% of my gross income is going out towards those obligations. Now, for lenders qualifying us, the maximum debt to income ratio is anywhere between 43 to 45%, depending on the program that we're utilizing. Now, I will say for most of our first-time buyers that I consult with throughout the day, the debt to income ratio they feel pretty comfortable with is anywhere between 33 to 36%. So it's almost 12 to 15% less than what the maximum is. And really, because debt to income ratio determines qualifying, it doesn't determine affordability. And we really want to design a home buying plan that's going to create sustainable home ownership for you that you feel is affordable. We don't want to stretch ourselves out too far, or we feel like it's going to be a reach to make our payment every month. Okay. So that's the debt to income ratio calculation. We'll review that together as part of your consultation. Now, one of the last components to building our home buying game plan is to figure out what our savings looks like for assets to use towards our down payment. As we learned earlier, we're going to need to save up money for down payment, but we also have to put together savings for closing costs. And at times that can be anywhere between $20,000 to $25,000. So we got to figure out how much we have in savings. We're going to talk about some solutions to maybe help us bridge the gap with assistance programs, but let's look at some of the documentation first that we would need to verify assets. So we'll generally need checking and savings account statements for the last 2 months. If there's any large deposits, we'll need to kind of paper trail those. If you just got your federal tax return refund, then that's totally sourceable, that's fine. But any unsourced deposits, we got to kind of figure out where those came from. Retirement accounts can potentially be used, 401ks, 403bs, IRAs. I would just encourage you to talk to your tax or financial advisor about the tax implications of maybe accessing money from an IRA account. So we don't want to create any tax consequence for you. And then gift funds can be potentially used. That's where a family member, so mom and dad or a sibling, helps out in providing resources for you for that, the down payment and the closing costs. And we'll walk you through kind of the gift fund process if that's a resource that you're going to be able to take advantage for your home buying. Now, when we look at designing home buying game plans for our clients, there's usually kind of two hurdles, if you will, that prevents clients from getting closer to the finish line with home buying. It's either usually credit challenges or it's just lack of resources for down payment. And like I said just a few minutes ago, most buyers that are just trying to buy on their own without any type of assistance support are probably going to need maybe $20,000 to $25,000 out of pocket just to purchase their first home. And so for some of us, that's just maybe a 2 or 3 year goal. And so when we look at trying to make homeownership more of a near-term goal, maybe in the next 6, 12 months, whatever your timeline looks like, the CalHFA assistance program can be a great resource to help you reach homeownership that much quicker. And let's kind of take a look at how a program like this works. And it allows you to borrow up to 3 or 3.5% of your purchase price to help take care of that minimum down payment requirement that we learned about earlier. So if I'm going to finance up to $642,000, minimum down payment is 3%. The state just enhanced this program. It used to be capped at $15,000. Now you can get your full 3% of whatever purchase price you're going after in the market. Now it is a low interest loan, so that's something we got to keep in mind, but it does not require payments to be made on it on a monthly basis. You just have to pay that back to the state when you either sell your home or if you refinance in the future. It is a simple interest loan at 1%. So if we borrowed $15,000, it's only $150 in interest, so cheaper than any other obligation we could probably have. So that helps satisfy our requirement for down payment. Now, as we learned a little earlier, there's also closing costs when buying a house. And that's where the ZIP assistance, or we call it the zero interest program, can help you out as well. And that's where you can borrow at 0 interest, 2 to 3% of your loan amount to help take care of those closing costs. So it can really help minimize the total out-of-pocket expense. And so what we do is in designing your home buying game plan with the CalHFA resources, we can take the My Home product, add on the ZIP assistance, and then lower the total amount of money that you'll have to pay out of pocket. Let me show you what an example looks like for a prospective home buyer. So let's say we're going to buy at $500,000. And as we know from earlier conversation, the minimum down payment is 3%. So that's $15,000 plus with my closing costs of maybe $10,000 to $15,000, depends on what we negotiate with the seller. But let's say it's $10,000 to $15,000. We're probably going to need about $25,000 to $30,000 out of pocket. So again, probably maybe a bit of a high goal for us in terms of assets for most of us. But with the assistance program, now we can get support from the My Home assistance of $15,000. Now we can satisfy the 3% down requirement. Plus we can get ZIP assistance of anywhere between $9,700 to $14,550 in support to help offset some of those closing costs. So instead of trying to figure out how we scrape together $25,000 to $30,000, maybe it's $3,000 to $5,000 to be able to purchase our home. And when we think about those numbers being a bit more attainable for us, that could help first-time buyers reach that goal of home ownership that much sooner. We feel very fortunate. We're actually the #1 provider of the CalHFA product across the state. So we're really well versed in the program. And so we can figure out how this can be the best possible tool for you if you decide to elect a product like this. So it does have offerings for conventional loans, FHA loans, VA, and USDA. The FHA version looks very similar. Just the down payment requirement changes because, as we learned earlier, it's a 3.5% down payment on FHA. So instead of $15,000, it would be $17,500. So that same full amount can get covered. And then we can also add on the ZIP assistance. So standard FHA, maybe it's $27,000 to $32,000 out of pocket. With the assistance, now we can lower that down to maybe a minimal of $3,000 to $5,000 out of pocket. And the reason why I share those numbers with the estimated $3,000 to $5,000 out of pocket, because it does change on every transaction. It really depends on what you negotiate with the seller. Now, as you heard earlier, the minimum credit score for the FHA CalHFA loan is 640. The minimum credit score for the conventional loan is 680. Just so you understand the acronym CalHFA, CalHFA stands for the California Housing Finance Agency. So CalHFA is the umbrella of the state assistance, and then FHA is a product under that umbrella, as well as conventional USDA and VA. So some clients get that kind of confused. It's HFA versus FHA. There is a maximum debt to income ratio requirement, which is 45%. So we can't have our debt to income ratio go beyond that. There is income qualifications, and it is based by county and the applicant's income, not the household income. So most first-time buyer programs, let's say if there's a local municipality program, it's going to be based upon 80% of the household income, where this is based upon the income limit set by the state for each county. And then we just look at the applicant's income. So in Riverside County, the maximum income is $130,000. Why that's important to look at the applicant income is because, let's say my partner and I make $100,000 and my partner makes $70,000. So combined, we exceed the Riverside limit. However, if I just apply just in my name, then my income is the only income being used to the calculation. So in that, theoretically, we could qualify for the program. Now, a first-time home buyer is not someone that's never owned. It's actually someone that hasn't owned in the last 3 years. So if you've owned a house back in 2010, now it's since sold and you've been renting for the last 3 years or last 10 years, whatever the case may be, you're still considered a first-time buyer. There's income limits on the program. So you heard about Riverside's limit. So that's 153. San Bernardino has the same limit. Imperial's 139, LA 158, Orange is 211, and then San Diego's 188. And then for those of you that are interested in other areas around California, we can send along those income limits for you. The CalHFA website is calhfa.ca.gov, and you can see more details about the product offering. Again, great tool and resource for you that as we consult with you and kind of build that game plan for you, we'd love to make that one of your resources for you. Speaking of other resources, we also have our medical professionals program. That's going to be for our clients that are maybe reserved, medical doctors, dentists, teaching professors, or newly licensed medical residents. And where the benefit comes with this program is the ability to have a little more flexibility when it comes to student loan debt. So let's say I graduated with $350,000 worth of debt. Instead of having to take the 0.5% calculation or maybe 1%, we'll have a little more flexibility with that program to maybe not include the student loan debt against the qualifying. Now, this is going to be designed for clients that are purchasing usually above the conforming limits, but just another great resource to have some flexibility for those clients that have a little bit more in the way of student loan debt.
Are there any programs for disaster workers or government employees?
Okay, so a question came, is there any special programs for disaster workers or was it first responders or?
That's what they asked.
Okay, so there's no special programs for the state assistance program. It's based upon California residents. So there's no special enhancements for those that are applying for that. CalHFA used to have an option where the My Home Assistance was capped at $15,000. And then if you were a fire department employee, the cap was removed. Well, just over the last few weeks, they've removed that cap for everybody. So anybody buying in California no longer has the $15,000 cap. Okay, great questions, guys. Appreciate you sharing that with us. Okay, let's talk a little bit about the steps of buying. So you've heard me kind of mention our home buying game plan, and that's something we put together as part of your consultation. Well, the first step in our journey towards homeownership on this 6 steps of home buying is our pre-approval. And the pre-approval is the output of our home buyer consultation. And a pre-approval shows the seller that we're eligible for our financing. And it's a certificate, it's usually in a PDF file. It will usually match whatever your offer price is going to be for your house. It's usually good for 60 days. If you're on a little longer timeline for your home buying, we can always recertify the pre-approval at any time. Does not require you to reapply again. Okay, so step 1 is going to be for pre-approval. That is the output of a consultation. And that kind of sets us off on the journey of house hunting. And house hunting is when we get a chance to look at different homes. You usually want to connect with a professional realtor that's an expert in your communities. We have a list of preferred realtors that we work with, people that we've had great experiences with, and we believe in kind of how they support our clients in the buying process. So once you get pre-approved, if you want us to connect you with a preferred realtor, we'd love to make that introduction for you guys on email. Now, as you're out house hunting, looking at different homes, we're going to update your pre-approval usually to match your offer price. And so we'll do that for you kind of right on the spot. So you can message us, text or email or through our mobile app, and we'll update that pre-approval for you right away. It's kind of a negotiating tactic. Some realtors don't care if your pre-approval matches your offer price or not, but most realtors want to see that if I'm buying a house for $500,000, that my pre-approval matches that amount. Okay, so if we go out and do the home search, it's going to probably take us a few times of making offers, maybe not get the offer on the first shot. So I would say, especially in this market, keep you encouraged and stay positive, because there is plenty of different options that are coming down the pipeline here for some of our prospective buyers, but it is a very competitive market. So it may take 2 or 3 offers to find the right house. Sometimes it takes even more. I can tell you some of our clients that have recently had success in getting their offer accepted. It took them multiple pre-approvals, multiple offers, 10 to 12 offers, and finally they kind of got the win of getting an accepted offer. So it takes a lot. So you got to be resilient. And my hope is that as this market starts to shift, there'll be more opportunities for us first-time buyers. Now, let's assume we hit the success or the jackpot, so to speak, and we have an accepted offer. We're going to now start the escrow process, and that's step 3. So step 3 means we have an accepted offer from a seller, and it's going to begin this 30-day escrow timeline. Usually that's 30 days. So from acceptance to when we get our keys, it's about 30 days. Within 24 hours of that acceptance, we're going to give you a call to schedule your follow-up consultation. That's where we meet one-on-one for a video consultation, just to talk about the terms and conditions of your offer, make sure I have the financing structure properly. As a buyer, within 2 to 3 days of that acceptance, you'll be required to make an earnest money deposit. And so that'll be something you'll have to do on your side. And then at that time of acceptance, usually the inspections will start to be ordered. So your realtor will order inspections on your house. We'll also order an appraisal on the property. And after we've completed your follow-up consultation over video, we're going to send out disclosures to you. It's usually going to be within 24 hours of that follow-up consultation. Now, you may ask, what is an earnest money deposit? So we want to kind of share with you what that means. Earnest money means it's a good faith deposit. It's usually 1 to 2% of your purchase price. That money gets held in escrow while you're going through your due diligence on the property, which I'm going to share with you in just a minute. That money will go towards your total out-of-pocket expense. And that money is protected while you're in what we call as the contingency period. And that's that due diligence or maybe the homework phase of the process, where you get a chance to get your house appraised. You heard about my example earlier this evening about making sure the house appraises for what we're buying it for. Your realtor is going to set up inspections on your house. We want to make sure the house is in good livable condition. And then finally, we want to get our loan approved. And the contingency period is usually in the first 14 to 17 days of your contract period, and allows you to be able to do your homework on the property. Because if something just doesn't add up for you and you just don't feel comfortable with the property, it allows you to cancel your contract and get a full refund of your deposit. Step 4 in our process is going to be processing and underwriting. That's where we do all the administrative work of your loan. So that includes verifying your employment, verifying assets. We're going to probably have your rate locked in before that time, because we're going to start getting everything prepared to go to our underwriting department. And the underwriters will approve your loan at step 5. And the underwriter's process is to review all your asset documentation, income, make sure the product selection is all set up correctly for you. And so that'll happen at step 5. It's also going to bring us to the end of your contingency period at that time. And so by the time we get to step 5, we're probably 3/4 of the way through the process, or maybe at week 3 in the process. So if everything checks out for you on your inspections, your appraisal, we have your loan approved, then you're going to sign off on your contingency. That tells the seller that you're okay with the property, you want to move forward in the process. Now, we want to be careful too. At the same time, we don't want to sign off on the contingencies if we don't feel comfortable in the property, because if you sign off today on March 16th and then March 18th, you say, you know what, I want to back out, then you could potentially risk losing your deposit. So you want to be really careful about making that sign off if you feel kind of uneasy about the property. Now, assuming you want to move forward and everything checks out, we're going to issue to you a final closing disclosure. And that gives you a 3-day cooling off period. And it's kind of the final disclosure before we get to step 6, which is actually closing your loan. And closing your loan is when you're going to sign final documents. And that's generally done in person with a public notary. It actually is done in person with a public notary. Takes about an hour, maybe an hour and a half, depending on the structure of your loan. And that's where you see all your final interest rates, payments, and out-of-pocket expense. All of that will match up and be, it'll sync up with all the previous disclosures that you've seen. So there's no surprises when you get to the final stage of loan documents. After you've completed that signing, then you're going to wire in the final amount due for your home purchase. That money gets reconciled by the escrow company, and then us as lenders will do one final audit and then wire in the funds for your first mortgage. If you've elected maybe the CalHFA assistance, we'll wire in those funds as well. The escrow company makes sure everything is balanced, so you as a buyer are contributing what you're supposed to. It fulfills the purchase agreement. And then once that's completed, they'll release documents to be recorded at the county recorder's office. And the documents that get recorded are usually a grant deed, and that transfers ownership over to you from the seller. They also record a deed of trust, which is your agreement to repay the loan. And once all those items get confirmed as recorded, then you become the official owner of the home. You get a chance to call your realtor calls you and say, hey, great news, we're on record. You get to get the keys to your house. We do a virtual high five. And we get a chance to celebrate this huge accomplishment. So it's a big deal. Like I said earlier, when we first kicked off tonight's discussions, probably the largest investment you're going to make in your lifetime. So just a big accomplishment. Now, if we kind of rewind things a little bit, and before we get on that journey towards homeownership, it starts with the consultation. And that's where we develop that game plan for you for home buying, so you can get on that journey towards homeownership. The link to the online application, if you want to kind of start that process, is all on this page here, as well as some of the documents that you'll usually need to upload. The application prompts you on what to upload. And then once you've done that, you can schedule a free consultation with us for 30 to 45 minutes. It's one-on-one with me. I recommend doing it over video, because then we can screen share with you and show you different scenarios. And I'll show you kind of the framework of the home buying, the consultation in just a minute. Now, after leaving tonight's class and you just have some questions that you want to run maybe your financial situation by us, and you want to kind of talk about some of your goals or maybe a little more information about the process, I really encourage you to schedule an introductory call with us. That's 10 to 15 minutes phone conversation. And then we can kind of help you better understand what the next steps would look like. The consultation is going to be some budgeting. We're going to develop that plan for you. We're going to talk about different locations that you're considering in California, interest rate options, closing costs, product solutions. We review your credit. So if we need to do a deeper dive and help you get you on the path with credit, we can certainly do that. We'll walk through the buying process. And then the output of a consultation is to have you pre-approved and be able to get you on that path towards step 2, so we can begin the home search. And it's a free service we provide, so we want to do it very consultatively. So even though you do a consultation with us, it's not like a hurry up and go buy a house. We want to make sure that it feels right for you. We want to make sure we get you in a spot where it's going to be sustainable, affordable home ownership. Whether that's buying this spring or next spring, we at least want to help put together a game plan for you. Some great tools and resources we have include our mobile app. You can actually start the application right there from the mobile. You can also upload documents. And then once you're in the buying process, you can follow the progress of your loan all through mobile. Now, you're probably joining us tonight because of our UC Riverside partnership. We love working with our UCR team, and we have similar partnerships across the state and actually on the East Coast too as well. And with our partnerships, we provide discounts on our closing costs, and it's usually $750 discount. So in our closing cost structure, we have a $910 processing fee. We drop that down to $160 as our affiliation with these partnerships. So whether you're joining us from UC Riverside or maybe Long Beach State, these are partnerships that we love to pass along these discounts to. You heard earlier, these are free consultations that we do to help build your home buying game plan. So they're available for anyone that we partner with. Like you've heard earlier, this is probably going to be one of the biggest investments you make in your lifetime. We want to be your trusted mortgage partner along the way in the journey. And if you do need some help with real estate partnerships, we'd love to be able to make that connection for you. Again, we appreciate you joining us this evening and taking the time out to kind of learn about this process. We teach these classes every couple weeks, actually every week, I should say, for different partnerships. And we have some other workshops upcoming. So obviously you're joining tonight's class, but we have classes next week and for the next several weeks beyond. So if you really enjoyed tonight's content, you want maybe share this with friends, family, coworkers, have them check out mortgageeducate.com. We'd love to have to see them at one of our upcoming workshops. And we'll be kind of changing some of the content throughout the year for some of our newer class or newer attendees. This is all my contact information, so feel free to message me via email. You can text me, give me a call to just answer any follow-up questions. And if you want to schedule that intro call, you can click on this link here, and then we can go through your personal financial situation and kind of figure out what next steps could look like for you, or even schedule your consultation. Here's some of our social channels. We love what our clients say about us on our reviews on Google or Yelp. For Instagram, Facebook, we love to celebrate homeownership. I can't tell you how many graduates from these workshops we've taught over the last 6-7 years get a chance to celebrate homeownership with them on our social channels, because we believe it's a big deal. And we, when you get to step 6 and you're getting the keys in your hand, we want to be there as a partner to celebrate with you, because it's an incredible journey and it's a huge accomplishment when you get there. So with that being said, I want to kind of just hang out here with you guys a little bit. We're going to answer any follow-up questions as we wrap up tonight, and we'll keep the lines open. So if you do have questions, feel free to go ahead and use the chat button, and we'll go ahead and get those shared with the group here. So I'm going to go ahead and just turn off video, but I'll hop back on with some of these questions that we have. Okay. Okay. So question was just, is really just my opinion on the timing of buying. Is now the right time? I got the same question earlier today in consulting with a client. So I think it's reasonable for it to be going through everybody's kind of thought process. I think everybody's situation is a little bit different. I mean, if you're at the end of your lease and you're debating on, what I'm going to pay in rent versus buying, still could make sense. Costs of homes are certainly have climbed, as you saw in the earlier slides, but real estate still remains a fantastic investment, but it's not for everyone. I think that's where you can sit down and really kind of look at a game plan and figure out, is this a 2022 goal, or does it need to be a 24 goal or 23 goal? I think with interest rates changing and probably not slowing down over the next 2 or 3 years, I think that's something we really got to consider. And we hope that market will cooperate in the housing side of things, where maybe inventory levels will increase, and maybe we can get a little bit of softening in prices, so it can allow some of our buyers to enter the market at reasonable prices. That's a good question. That does come up for sure, but hopefully that helps you.
Someone just asking if we could still help them out of state.
Okay. Yeah, I mean, if you're looking to buy out of state, we lend all over the United States. Our team is specific to 3 states, but we have options to be able to service you all over the United States. So just let us know kind of where you're looking at. As part of our consultation, we'll get you one of our team members. For example, one of your fellow alum just purchased in Arizona, and they attended one of our last UC Riverside workshops. And so that's something where in his particular situation, he's working remote as well and moving to Arizona. So we can certainly service you there as well. I saw that question pop up too, so you can answer. Okay. Okay, so the question came in as the whole remote work, or having remote work being required for your underwriting process. So with qualifying for a mortgage and having, let me just kind of give you this example. So let's say I'm working in LA, but I'm buying in maybe, let's say Riverside, which is, it gets commuted, but let's say that's not commutable right now. If you are on remote work, it has to be permanent remote work, because through the pandemic, as we've seen, many employers went to remote work, but it's not permanent remote work. So in some cases, lenders will ask for a verification of employment to indicate that it is a remote position. And so because it can't be temporary, because obviously if it changes at some point, then that would change your commute situation. So we've seen that with a lot of tech companies, especially in the Bay Area, where people are getting out of the high cost of living in the Bay Area, maybe moving to Sacramento, but not necessarily having a full-time remote position to be able to leave like the North Bay Area. So
Can you see the question?
yeah, okay. That makes it a little easier, huh? So another question came in. So softening the market. Can you explain what softening the market means? So that's probably my own little phrase that I'm using, softening the market. When I say that is that I'm seeing purchase price at a certain level, but data not supporting that purchase price. That's kind of where I go with that. So like houses that or purchase prices at 450, but the market data is saying 430, and I think more and more of that trend is happening. So it's kind of creating a little bit of instability in the market. Whereas before we'd see like 450 and now the house is appraising for 460 or 470. I just think that's where I'm seeing a bit more on the softening side. And then, okay, another question came in. Is it true that comps matter more than upgrades to the individual home? That's a good question. So comps have different characteristics to them, if that makes sense. So if I have a house that has a pool, solar, bigger lot, and I'm comparing it to a house without a pool, smaller lot, and maybe a detached garage, there's adjustments that appraisers will make based upon those characteristics, and they put a dollar amount in comparison. So if I have a $450,000 appraisal, but a house a block away sold for $410,000, they'll look at the difference in characteristics as to why that house sold for 410. Well, it didn't have solar, didn't have pool, the roof was 10 years older, that kind of thing. So those are called appraisal cost adjustments. And so that's, there may be a comparable sale that's used for a property, but it may not necessarily be an exact model match. And that's why the appraiser will make adjustments. Sorry for the long-winded answer, but. Okay, these are good questions tonight, so we appreciate that. We'll hang out here for a couple more minutes. You guys have any other questions? Yeah, so, the question really, I'll kind of generalize the question. Should I have everything kind of all set up with my finances before I make the call in? I'd say, call us whatever position you're in, whether you're, ready to go or you just want to kind of talk through things for home buying, just give us a call. That's what our job is to do, is to kind of just help answer questions for you and get you on the path towards homeownership and explain next steps. So, and then, okay, so another question came in. Have you got a chance to help renters that currently are in a single family home and they're looking to buy from the landlord? And the answer is yes. I mean, that's happening more and more now because landlords are looking to sell because of where the market is at. So yeah, absolutely. So that's usually called a for sale by owner, unless the landlord is using an agent to represent them. And that could be a great opportunity for you, because if a landlord's able to sell that directly to you, it might help reduce their expenses of paying maybe a realtor to bring another buyer to the house, and potentially be able to sell the house to you at maybe a lower price. But certainly we definitely help buyers with that. Do you want this next question? You want me to tackle that? For someone who's having an agent, even in a for sale. Okay, so next question is, should a for sale or should a first time buyer always have an agent as a for sale by owner situation? That just depends. I mean, I think it depends on the relationship with the seller or the landlord. I recommend taking advantage of the resource of a realtor regardless, but I think it depends on your, like I said, your situation with the sale of the home. a reason for a landlord wanting to sell to a tenant is obviously ease and convenience, but potentially be able to reduce expense with not having to pay a realtor. But that, I think it'll just depend on your situation. So another question came in, how long does it take roughly to get from pre-qualifying for a loan to searching and getting an offer approved? Depending on the location, and this particular individual is looking in the Bay Area. So how the process looks is that the consultation, same day you'll get pre-approved. So we'll issue that as soon as we hang up from the video call, and then you'll start the home search. The home search really depends on how quickly. On average, I would say buyers are taking about 2 to 4 months to find a house. Now, some clients it's unfortunately taken 2 to 4 years, but on average, I would say 2 to 4 months. Hopefully, it'll kind of lessen as we get more opportunities in the market. And for your question, since you're talking specifically to the Bay Area, I think that's a pretty fair number. Now, I've had some buyers in the Bay Area find a house in a week and they're already in escrow. I've had some clients that's just taken longer. I think it really just depends on your price point of your home and the location that you're looking at. So hopefully that answers your question, getting offer approved. Yeah. So I think that's probably a fair estimate. And then once obviously you have an accepted offer, then it's usually going to take 30 days. So we would say 21 to 30 days for the closing process. So question is, if you haven't found a home after 6 months, do you still need to go through the pre-approval process again? Good question. So we do things a little bit differently. We'll recertify your pre-approval because as you've heard earlier, we've had clients that have been shopping for quite some time. So if we pre-approve you today, pre-approval is good for 60 days, but if it takes you 6 months to find a house, we can recertify your pre-approval. Doesn't require us to have you reapply or anything. And because we're only starting with a soft credit pool, it's not going to hit your credit score again. Great questions, guys. You guys are going to get the award for best questions for this year, for sure. Absolutely. All right. Anything else? Okay. All right. Well, it was wonderful hanging out with everyone this evening. I really hope I get a chance to connect with you either for that intro call or that consultation. And, we can get a chance to put that home buying game plan for you and get you ready for the spring and summer buying months. Or if you want to get ready for next year, we'd love to be able to be that partner to do that with you. Thank you so much for joining us this evening. I hope to connect with you soon. We'll talk to you soon.